Level 4, Chapter 1. Econometric analysis is a complement to fundamental analysis, which deals with statistical relationships between financial assets and the factors that influence their prices. Don't be scared by the word statistical. Econometrics is not rocket science. Rather, it is an elegant solution to questions that pure qualitative judgment cannot solve. Econometric models, also called regressions, are a tool for predicting future price movements. Regressions allow you to make predictions that have accuracy of over 90%. Regressions can be helpful for predicting only if a trader structures them properly. Otherwise, they can lead to false and dangerous conclusions. Regression models should be used in combination with fundamental and technical analysis tools. Alone, they are not enough for a price prediction. Before going into deep water, though, the statistical concepts that underpin regression models should be discussed. Arithmetic average, mean. Arithmetic mean, also called arithmetic average, equals the sum of given numbers divided by the number of these numbers. For example, if the price of stock XYZ equals $10 on Monday, $12 on Tuesday, and $16 on Wednesday, then we can calculate the average price for the 3 days by summing 10 plus 12 plus 16. Then we divide this sum by 3, the number of days, and we get that the arithmetic mean equals $13. In econometrics, the asset price at a given point in time is called observation. Median. The median is the middle value number in a series of numbers. For instance, if you have a series of weekly prices for stock ABC, which is, say, 2, 5, 7, 8, 9, then 7 is the median observation, since there are two values that are less than it, 2 and 5, and two values that are more than it, 8 and 9. i.e., 7 is the middle in terms of value. Variance and standard deviation. Variance equals the average distance between each observations and the arithmetic mean of these observations. It is widely used as a proxy for measuring one of the most important characteristic of every traded asset, its volatility. Standard deviation is simply the mathematical square root of variance. Essentially, it is the same thing as variance, just in a different format. Volatility means risk. The more an asset price fluctuates, the higher its risk. Therefore, the variance and standard deviation of an asset gives us an idea of its riskiness. The price of assets fluctuates between the bounds of two standard deviations in roughly 95% of the time. For instance, if the price of stock ABC today is $4 and its daily standard deviation is $1, we can expect that tomorrow its price will be between $2 and $6 in 95% of the cases. Arithmetic return equals the percentage difference between the value now and the value of the previous period. For instance, if stock ABC cost $10 yesterday and $11 today, our daily return equals 11 minus 10 divided by 10 equals 0.1 equals 10%. However, when we wish to use return in an econometric context, instead of arithmetic return, we should use logarithmic return. Logarithmic return is calculated as the difference between the logarithmic values of the price today and yesterday. The logarithmic return of stock ABC from the example above equals ln 11 divided by 10 equals 9.5%. Standard deviation and variance can only be applied on a single asset. However, they do not tell us anything about the relationship between one asset and another. In order to measure interdependency between two assets or factors, we use correlation. Correlation is an extremely important measure for risk minimizations and return maximization. Correlation can assume values between 1 and minus 1. If we have correlation between minus 1 and 0, we have negative correlation, meaning that, on average, when one asset is going up, the other is going down. If we have correlation between 0 and 1, we have positive correlation, meaning that, on average, when one asset is going up, the other is going down. An econometric regression represents a model whereby one dependent variable, e.g. stock price, is explained or predicted by one or more independent variables, e.g. inflation, interest rates, etc. An econometric regression looks like this. If money in circulation goes down by 10%, consumption goes up by 25%, the exchange rate goes up by 15%, then, applying the above equation, we can predict the expected return of stock ABC. The coefficient before each variable in the regression is called beta. Beta measures the sensitivity of the explained variable to movements in the explanatory variable. Refer to the previous slide. The beta of exchange rate equals 2.3, which means that a 1% change in inflation will cause a 2.3% change in stock ABC's return. Before interpreting beta, one should look at its p-value for statistical significance. The p-value measures whether or not the variable is statistically significant. If it is not, we disregard it and drop it from the regression equation. The explanatory power of a regression is measured by the adjusted R-squared measure. If the regression from the previous slide has an R-squared of 20%, this means that the regression explains 20% of the price movement of the explained variables. The rest should be explained by technical and fundamental analysis. Regressions can be computed by software, yet the variable selection process is done by the trader because it needs human judgment. The CAPM abbreviation stands for Capital Asset Pricing Model. CAPM is the most widely used model for asset valuation by financial specialists around the globe. CAPM, in its basic form, measures how much the price of a given asset is influenced by the movement of a broader index asset. CAPM is nothing more than a regression that looks like this. Stock return equals risk-free rate plus beta times market return plus EI, where risk-free rate equals the return of US short-term bonds, market return equals the return of a broad market index such as S&P 500.